August 1st, 2017. Today's editorial is entitled Exchange Pileup. Alan Greenspan warned of further disorderly adjustments to interest rates. He sees a bubble. He would know as King Bubble Maestro. Equity bears screeching excesses in the equity markets would be better served observing bond prices, according to Greenspan. Bonds are an actual bubble, and when it bursts, it's bad juju for everyone. Greenspan said yesterday, by any measure, real long-term interest rates are much too low and therefore unsustainable. When they move higher, they are likely to move reasonably fast. We are experiencing a bubble, not in stock prices, but in bond prices. This is not discounted in the marketplace, Greenspan said. Equities will suffer with bonds. Surging real interest rates will challenge one of the few remaining valuation cases that looks passively upon U.S. equities, or so the Maestro suggests. The Fed's model assumes while bonds increase faster than stocks, equity investors are correct in staying the course with a lower inflated asset. The tremendous irony above is the Federal Reserve is on hold for now. In January of 2017, the 3-month T-bill was 53 bips. Today it sits at 107. A double off the wall due to 2 interest rate hikes. The 30-year bond began 2017 at 304 bips. Today it resides at 289. Rapid compression tends to catch everyone off guard. Historically, an inverted yield curve has been viewed as an indicator of pending economic recession. When the short end of the yield curve exceeds the long end of the curve, market sentiment suggests that the long-term outlook is poor and that yields offered by long-term fixed income will continue to fall. Price be damned, unless, of course, the Fed permits global forces to pick up control of the short end, in which case we would see the precursor in motion, which it is well underway. The 60-70 euro is spiking to complete and fill the gap at the 120 level. The dollar is completing a downtrend and looking to establish a base from which to reverse. Real interest rates will begin to rise dramatically. This is not good for gold nor silver. The dollar could actually fill the overhead gap at 108. That would be a very messy issue for the metals. My thesis remains as such, and why I'm extremely bearish on the precious metals complex. We are within a few days to a week of this setup completing. Could it drag on for another week? It could, but I do not believe it will. Many believe this is bullish for gold and silver. History has shown time and again it is not. Prepare accordingly. I'm looking for a blow-off in equities and metals to be followed by a rather large decline. One that warrants a large hedge against price. Have a good day.